the Bitcoin moved up during a risk-off, a very important risk-off moment, the regional bank crisis in March. It went from 19,000. This is a long-term chart, so what I'm telling you is an intraday. It hit a low during that regional bank crisis at 19,000 and shot up to 30,000. Why was that? Flight to quality, as Larry Fink would say. We do think that both Bitcoin or crypto or digital assets and artificial intelligence now could become part of the election year debate.
Cathie Wood, the head of ARK Investment Management, has once again emphasized her perspective on Bitcoin as a safe haven asset during times of economic uncertainty. Last month, the U.S. government avoided a shutdown by agreeing on a short-term funding deal. This bill, securing funding until November 17, received strong support and was signed into law by President Joe Biden just before the deadline. This situation has some Bitcoin supporters predicting a rally similar to what happened during the regional bank crisis earlier this year. In early 2023, Bitcoin's price rose due to concerns over the regional banking crisis. Similarly, worries about a potential U.S. government shutdown have driven Bitcoin's price upward. Cathie believes that Bitcoin, cryptocurrencies, digital assets, and artificial intelligence could emerge as topics in the election year discussions. She observed that within both the Bitcoin and crypto asset communities, as well as the AI community, with the exception of the major players, there is significant discontent with a recent executive order, which has stirred a considerable response. The cryptocurrency market continues to experience some euphoric price moves from altcoins as Bitcoin remains the primary determinant and dictator of the market in recent weeks, as price broke above key resistance of $32,000 to a high of $35,800 as many analysts, traders, and investors believe this could be the spark of a bull run. Cathie Wood mentioned that the rise in Bitcoin prices can be attributed to a move towards quality and safety. She's previously predicted that the price of Bitcoin would exceed $1 million in the next decade. It's currently $35,000, roughly half its 2021 peak. But after crashing 64% in 2022, Bitcoin's value has more than doubled this year as market participants touted it as a potential inflation hedge. Now let's shift our focus to a video. Before we get started, make sure to subscribe to the channel and click the bell icon for the latest updates.
We have been in effectively a bull market with higher lows since its inception, and here we are again. We're on the way up. I think what happened this year is quite significant. It happened that the Bitcoin moved up during a risk-off, a very important risk-off moment, the regional bank crisis in March. It went from 19,000. This is a long-term chart, so what I'm telling you is an intraday. It hit a low during that regional bank crisis at 19,000 and shot up to 30,000. Why was that? Flight to quality, as Larry Fink would say. Flight to quality, as we would say. Flight to safety, as we would say, because there is no counterparty risk here in this decentralized, transparent monetary system, unlike what happened to the fiat monetary system in 08-09. And I think more people are beginning to understand that this is not just a risk-on asset. When the markets are feeling really good, Bitcoin tends to do very well. But can you believe it's also a risk-off vehicle? And more investors, including institutions, are beginning to understand this. So this is innovation at its best, and it is one of the 5 major innovation platforms around which we have centered our research. So robotics, energy storage, artificial intelligence, blockchain technology, and finally multi-omics sequencing. And this is the innovation platform we want to focus on a little bit today, the miracles coming out of this source of innovation resolution, so we don't have to deal with this over the holidays and move the debate into January. It's just becoming de rigueur now, and I think investors are getting used to it. They don't like it. Nobody likes it, but it is what it is. The other thing that happened actually this week was an executive order on artificial intelligence, which we think can be described as serious overreach and certainly favors the incumbents and we think would really hurt innovation. So it is an executive order. We do think that both Bitcoin or crypto or digital assets and artificial intelligence now could become part of the election year debate. It seems like both groups, the Bitcoin and crypto digital asset community and the AI community, except for maybe the largest players, are both up in arms about this executive order. If it becomes an election year issue, we believe that candidates will distinguish themselves on with their points of view on these topics. And what I found interesting in our brainstorm today is that both of these, the crypto/digital assets controversies vis-a-vis this administration, and now the AI controversy, both of them are bipartisan. So they'll get some attention. And if there is a change in the administration, of course, that executive order will probably be no longer because, again, we think it's going to become an election year issue.
The U.S. money supply is shrinking for the first time since 1949 as savings deposits decline and the Federal Reserve shrinks its $8 trillion balance sheet. Moreover, the U.S. Treasury bond curve inverted back in mid-2022, but has paired much of that move since the middle of this year. The yield premium on 2-year bonds over 10-year ones has now narrowed to just 24 basis points after October's bond market meltdown from as much as 109 basis points at the start of July. In a recent Bloomberg podcast, Cathie Wood says she would unambiguously wager on Bitcoin rather than gold or cash to safeguard against the possibility of deflation in the coming decade. Now let's shift our focus to a video.
We've never seen a decline in money like this in this period of time. You have to go back to the 1930s, which of course was the Great Depression, to see a decline in money like this. Now, this is the other side of what happened during COVID. So it's it's understandable to some extent. But now we're soon going to be lapping one full year of negative money. And so the course correction has taken place, we believe. If money doesn't pick up, then what we will conclude is it's becoming a serious drag on the economy. And deposits are leaving the system. The regional banks still are losing deposits. That's part of the decline in money. And that's not a good thing. In fact, the KRE Regional Bank Index is revisiting its March lows when we were in a crisis around the regional banks. So the regional bank index is a warning that Fed policy has just overdone it here. We hope it doesn't break down the index. And it is possible that some of the numbers coming out now are making the case for a Fed pivot so clear that the regional banks will not face as stiff a competition from money market funds and will be able to attract deposits again. So this is M2, still declining year over year. And here is the yield curve. Now, we've talked about the yield curve here many times. Here's the picture going back into the 70s. This is the 10-year Treasury yield minus the 2-year Treasury yield. And when it's below zero, it means that short-term interest rates are higher than long-term interest rates, which is not normal, as you can see from this chart. And you can also see that typically when the yield curve inverts, we are either in a recession or not far from a recession. And we would say we've been in a rolling recession for the past year and a half. The yield curve inverted for the first time in July of 2022. So it has been more than a year. And we think that it is a harbinger of much slower economic growth and lower inflation than most people believe. The other point we like to make about this chart is, to see a yield curve going down to -1 or -1% or 100 basis points, just like it did in the early 80s today, is quite something because the base of rates is so much lower. So today we have the long bond yield in the 4.5% to 5% range. Back in the 80s, that number was 15%, and yet we have had the same degree of inversion here. That tells us that monetary policy today is much more stringent than it was even in the early 80s when interest rates were at 15%, because 100 basis points on 4.5% to 5% is a lot more dramatic than 100 basis points or 1% on 15% interest rates. So we think monetary policy is much tighter than many understand. And we do believe it will have far-reaching ramifications over the next year or so.
Investors typically seek safe haven assets for stability during uncertain times, often turning to government bonds, especially U.S. Treasuries. Recently, however, the Treasury bonds have failed to live up to their reputation. According to Allianz's chief economic advisor, Bitcoin, the world's largest cryptocurrency, offers more of a safe haven than U.S. government bonds these days. That concludes our conversation for today. What's your stance? Feel free to share your thoughts in the comment section below. If you found this content informative, please consider giving it a thumbs up and subscribing for the latest updates. Thank you for being here with us.